This is your new venture after AB, after you gave up the helm there. You've raised $4 billion from an Italian insurer, Generali, and you plan to launch fund management products and fees. Talk to us a little bit about the products that you intend to have.
So over time, we'll have a range of investment strategies, and those investment strategies will be designed to be interesting to all investors. So we view our firm as a firm that will have investment services that are available to all who want to invest in them. That would include individuals as well as institutions.
The thing that's really interesting, too, about your new firm here, Peter, is something you've talked about a long time. It's about fee structures embedded in mutual funds. Can you tell us a little bit about what's different about your firm and how, you're eventually going to be paying your portfolio managers?
Thanks, Sonali. Sure. Well, first of all, it's a new firm, as we said. Secondly, the revenue model of the firm is aligned specifically with the client's objectives. The client's objectives are to have performance. The fee structure of the firm is that clients pay a base fee equal to the average of ETFs, and then performance fees only if there is performance. So these performance-linked structures only occur if, in fact, the managers deliver the performance that the client wants.
We've seen Fidelity, for example, come out with their zero-fee mutual fund. Is this the new normal? Are fees going to be driven down across the entire industry? And are portfolio managers willing to take just performance fees?
Well, I think that's a really good question. I do think over time, call it the next 10 to 15 years, the industry will shift to revenue structures that actually are aligned with clients' incentives. I think portfolio managers will struggle with this, because if you're a portfolio manager today and you're managing money with fixed fees and you get paid whether or not you perform, it's challenging to move to a performance structure. But on the other hand, if I'm a client and I'm investing, I ought to be paying my portfolio manager only when they perform. And I think that the world is filled with people, with portfolio managers who actually want to be paid for their performance and understand that if they don't perform, they may not get paid, and that's something they're willing to do.
Peter, you say that the real danger out there is the ETF world, and also that there are too many active funds out there, yet you are going to have partially an active structure. So tie that up for us. What do you mean?
Great question. So one of the beauties of this revenue structure that we have is that it limits capacity. So if you're a portfolio manager and your incentives under a fixed fee structure are to just gather as many assets as you can, because that's how your compensation goes up, what happens to you is when you have more and more assets, it's very difficult to perform. And what we see in the industry is a lack of performance net of fees, because funds get to be as large as they can get. Institutions build big marketing organizations. They spend a lot of time on marketing. They have a lot of time on selling. And the focus shifts from performance to assets under management. Portfolio managers will say they all want to perform. But at the end of the day, if they don't perform and they get paid basically the same as when they do perform, the motivation is to gather assets. Our revenue model shifts that. It says to the portfolio manager, you only get paid if you perform. Now, as a portfolio manager, I think about how many assets can I actually manage and still perform. Because if I don't perform, it doesn't matter how many assets I have.
So I guess the question becomes, how do you perform? Where do you find, if indeed there is the challenge that Sonali highlighted, which is to attract people to a different kind of model, attract portfolio managers, that is, how do you attract the best people who are then going to get you that performance that you're looking for?
So I've interviewed many people now in the last 9 months, over 75 people. It's counting close to 100, actually. And I've found a number of people who actually, in the industry today, who are paid on a fixed fee, but believe they would rather be paid on performance. And most people have said, no, I like being paid on a fixed fee because it's too risky to be paid on performance. Risky for them. I actually don't want that person.
Right.
I want the people who actually want to be paid on performance.
But will you have sort of a set strategy, or are you giving broad discretion to your individual portfolio managers, or was there a mentality sort of at the firm?
Well, the portfolio manager themselves will choose the strategy that they're comfortable investing in. We want portfolio managers to, since they're paid on performance, they have to be comfortable with what they're doing. So we're searching for talent. At the end of the day, it's talent that drives our decision, not we're trying to build a large cap equity portfolio. It's I have to find the talent.
Peter, what about, who are your biggest competitors now, right? I mean, you've said that there's too many mutual funds in the world right now. So but you're starting a mutual fund firm. Why are you starting a mutual fund firm, and how are you supposed to win? Who are your competitors?
So look, the competitors for us are the industry as it stands today. I think that that's going to be challenging to compete against, but I think we actually have a leg up. And the reason why we have a leg up is we are aligned with clients. And when clients look at the industry for the last 10 years, they've been taking money away from active management. That's been the raging story. We offer an opportunity now for clients to actually invest their money with a portfolio manager and a firm who is completely aligned with their objectives. Now, if you believe at the end of the day that humans cannot produce performance, and all you want to do is own a passive index minus fees, because that's what you'll get, that's fine. That Aperture's not for you.
So you're believing humans can still outperform AI, or humans can still outperform, these passive strategies?
I don't think it, I know it. I think there's no question that humans can perform.
What's wrong then with the mutual fund industry today, besides that there are too many of them?
I think that there's too much money being managed by each particular manager. I mean, that's not true for every manager, but on the whole, capacity is not limited. And when you don't limit capacity, it makes it more and more difficult to take the best ideas that you have and spread that over the money that you're investing. And that's a mathematical fact, and everyone knows that.
Peter, how come such interest from Italy?
Well, I think Generali represents not only a global insurance company, but an innovative management team who is thinking out of the box. And, I wanted to think out of the box. And it's one of those times when, you sort of have right timing. I was thinking of a strategy. They were thinking of a strategy. We both were trying to be innovative. And, it worked.